Today we'll be talking about the accounting framework. First, we will look at the fundamental qualitative characteristics of financial information. Relevance is information that is relevant if it is capable of making a difference to a decision. Materiality is a subconcept. Materiality refers to if the information is large enough or special enough to matter. It is an entity-specific guide to significance. This concept allows the entity to bend rules and standards that it would otherwise follow. Next, we have faithful representation of economic phenomena. There are three attributes that constitute this concept. First, completeness. Once we determine something is relevant, we have to have full disclosure of it. This can be done in your footnotes. Information must also be neutral, which means it is not biased. Prudence was an accounting concept before, but no longer. This is because prudence was biased in favor of conservatism. We want the most faithful representation, which is not necessarily the most conservative one. Finally, it must be free from error. You do not want erroneous information. Accounting recognizes that estimates are acceptable, because after all, estimates are an inherited part of accounting. To be decision useful, you need both relevance and faithful representation. If you have both, by definition, the information is considered decision useful. Now we'll be looking at enhancing qualitative characteristics of financial information. These characteristics do not make information more decision useful by themselves. They make them more or less decision useful. First off, we have comparability. This can be seen when you compare the same entity over time. This can be seen when they are showing 2 years in the balance sheet, income statement, or cash flow. It can also be seen when you're comparing entities across the same industry, such as one retailer to another. Comparability is the goal. To get to it, you must have consistency. To reach consistency, each business will need to follow the same rules for the ultimate comparability. But there are accounting choices like inventory management and depreciation methods. Therefore, there has to be judgment in accounting. Verifiability. Information is more decision useful if various parties can agree on how the information is recorded. This can be direct or indirect. Direct includes invoices and keeping cash in a safe. Indirect means you know the inputs and then know the outputs, such as calculating depreciation. Next, we have timeliness. Used to be part of relevance, but no longer. Information presented sooner than later is more decision useful. Finally, we have understandability. Information must be understandable to a person of reasonable business knowledge. They are presumed to have some training in accounting. Although sometimes you may encounter information that is incredibly difficult to understand, you still have to disclose it regardless.